Welcome back. We're taking a look at Module 3, Stock Exchanges. Now this is a very interesting module. We're going to talk all about stock exchanges. What stock exchanges are suitable for investing, what stock exchanges should be avoided. And let's just jump right into it here. Now, what are some reputable stock exchanges? You've likely already heard of these exchanges, but let's just go over it. NYSE, New York Stock Exchange. This is the largest, oldest, most reputable stock exchange in the world. This is because the listing requirements are very high. The listing requirements are minimum standards that a company must meet in order to be listed on the exchange. Therefore, smaller, less profitable companies are not allowed to be traded on the exchange. Now, the biggest companies in the world are listed on the New York Stock Exchange. Bank of America, Coca-Cola, Visa, Disney, Home Depot, General Electric, ExxonMobil, AT&T, Walmart, the list goes on. We would call these companies blue chip companies, and they're household names. They're big companies that have been around for a long time, and the New York Stock Exchange has listed those companies. And what do I mean by the New York Stock Exchange has listed those companies? Well, a company must meet the listing standards for an IPO. We're going to talk all about IPOs in a minute. But not only do they have to meet the standards, but they have to maintain the standards. If a company does not maintain the listing standards, then what will happen is what's known as a company being delisted. And it usually happens when a company goes bankrupt. They're not able to keep a certain price per share, and the company's no longer allowed to be traded on the New York Stock Exchange. Again, this is something that's quite rare, and we'll talk a little bit more about it in a minute here. But maybe you've placed a couple trades and you've been searching stocks and you see NYSE, but then you also see MKT. What's all this about? Well, what this is, it's a sub-exchange of the New York Stock Exchange. It's the New York Stock Exchange Market Exchange. And it's a division of the New York Stock Exchange, but it's designed to list smaller companies that don't meet the listing criteria to be listed on the New York Stock Exchange. It's still a reputable exchange, but keep in mind, you're investing in a smaller company. And you're probably wondering, where's the Nasdaq? Well, the Nasdaq, again, it's a reputable stock exchange. Keep in mind, the listing criteria for the Nasdaq is lower than the New York Stock Exchange, but by no means is the Nasdaq a fly-by-night operation. Previously, maybe in the 90s, the Nasdaq was seen as lesser to the New York Stock Exchange, but today, the Nasdaq is actually home to most of the largest technology companies in the world. Let's take a look here. We've got Apple, Google, Microsoft, Intel, Facebook, Starbucks, Costco, Netflix, Tesla. A lot of great names are listed on the Nasdaq exchange. And the Nasdaq exchange, if we're comparing Nasdaq and New York Stock Exchange, the Nasdaq completely run by computers. Now, these aren't just your any old computers. These are high-speed, high-tech, high-security computers that run the exchange. In the previous module, we looked at the buying and the selling, the level 2. It's the exchange that processes all of these stock orders. In any given day, a stock exchange will process millions upon millions of orders. And computers are great at processing these orders quickly and efficiently. We're going to talk more about the responsibilities in a moment, but just back to comparing the Nasdaq and New York Stock Exchange. The New York Stock Exchange is a little more old school in that it still has a few floor traders. There's floor traders. Again, there's not as many as there used to be by any means, but there's still floor traders and there's still stock specialists that oversee buying and selling of specific stocks. So let's keep going here. So what are the responsibilities of the stock exchanges? Oh, before we go into that, we've got some nice photos here. On the right, we've got the New York Stock Exchange, beautiful American flag there. And on the left, we've got the Nasdaq Stock Exchange, right near Times Square, New York. So exciting places. You've likely seen these pictures on the news, in the newspaper, online. So that's where the exchange is home to. That's where the transactions happen. When you go to buy stock, when you go to sell stock, it's all done through the exchange. And now the responsibilities of the stock exchange. What do they do? What do they do for us as investors? Well, the most important responsibility is to provide an efficient market. I mentioned earlier, all the transactions are done through high-speed computers, and that's really efficient. If you want to buy stock, a couple seconds later, you own stock. You want to sell stock, moments later, your broker now has the cash for that stock. Your broker has high-speed computers that go directly to the exchange. The exchange has high-speed computers that buy and sell with other stockbrokers. So it's all a very efficient marketplace. But keep in mind, not too many years ago, it was completely done by hand. You would phone your broker would phone the exchange would have a floor trader, the floor trader would have to go into a pit, and they would have to manually obtain shares of stock for you. And so unfortunately, it's cost a lot of jobs because there's not nearly as many floor traders as there used to be. But at the same time, it's a much more efficient market for buying and selling stocks thanks to computers. We talked about listing criteria, and that's another key responsibility of the stock exchange. They need to list only quality companies. These companies go through a very thorough inspection before they're listed. And similar to this, the stock exchange must enforce listing standards. And so what are listing standards? We talked about how the stock must hold a price. It can't go below a certain price per share. But there's a lot of other things that a stock must comply with. These are the listing standards. So the companies that are traded publicly, they must comply with listing standards, and it's the exchanges that must enforce the listing standards. So what are some examples of listing standards? We talked about minimum price per share. A company must schedule quarterly earnings. Management must disclose stock transactions. Now, these are referred to as insider transactions, whether management is buying, they're selling, they're doing their company options, or anything like that. It's got to be on public record and file it with the exchange. A company must have an investor relations department, or at the very minimum, at least a contact within the company. And if you really are interested in this stuff, you can actually go on the New York Stock Exchange website, look at the listing standards, or the NASDAQ website. Take a look at their listing standards as well. A lot of detailed information there, but the more you know, the better of an investor you become. But you may be asking, well, why would companies want to go through all these rules just to have their company listed on a fancy exchange? Well, the answer is access to public capital. So what we mean here is companies, they take their private companies and through an IPO, they become public companies. And we're going to jump into IPOs. We're going to go right into it in just a moment here. But the IPOs are designed to raise capital, raise a lot of money, millions upon millions of dollars upon putting their company public. And the money is generally to grow their company at a much larger, faster pace than they could without public capital. So take the fitness company Fitbit. Now they're using their recently found IPO money. They're going to have more research and development. They have a lot of new marketing now. It's helping drive the company faster and further than it could without public money. Take a look at Shake Shack. It recently IPO'd, and it's going to use the money from the IPO to expand more restaurants across the United States. So let's jump right into an IPO here. There we go. Allow companies to obtain public capital and facilitate an IPO. Well, an IPO, it's a very complex process. Let's see if I can break it down just a couple sentences here. So an IPO needs an underwriter from an investment bank to work with the exchanges to prepare the IPO. Again, IPO, initial public offering, the first time the company is available for sale to the public, the transformation between a privately owned company and a publicly traded company. So there's always a prospectus detailing the IPO, and it's sent out to investors and funds, and those investors and funds are usually the first ones that are going to be buying the stock right when it first is available. So when the opening bell rings and the company is now selling stock on the open market, that's when the magic happens. That's when the company is now a publicly traded company, and the value of the company is dictated by the market. The market is the buying pressure and the selling pressure. And usually prices skyrocket the first day of the IPO. Usually they double, sometimes they triple. Again, every IPO is different. Some IPOs don't do so well. Facebook IPO, it went up, but then it went down. And it took a long time for Facebook to actually recover to their IPO price. So that happens when they maybe sell a little bit too much. They maybe overvalued the company, and the market dictates the company's not worth that. Now, of course, Facebook, it's been a success story. It's definitely surpassed the IPO price, but every IPO is different. Just because you're buying an IPO doesn't mean you're making boatloads of money. Maybe in the past it did, but in today's IPOs, you really got to watch. It's very much volatile during the IPO stage. The news is out on Wall Street. There's lots of buying. There's lots of selling. It's an exciting time in an IPO. If you're really interested in the stock market, it's a lot of fun.